Money is a fundamental aspect of human society. It shapes our daily lives in countless ways. From buying groceries to investing in stocks, money is at the core of our economic interactions. But what exactly is money? At its most basic, money is a medium of exchange. It's a tool that allows us to trade goods and services efficiently. The concept of money has evolved dramatically over time. In ancient societies, people used various objects as currency. These ranged from cowrie shells to large stone discs. As civilizations grew more complex, so did their monetary systems. The development of money parallels the growth of human society itself. It reflects our increasing need for more sophisticated economic tools. Money serves several crucial functions in our economy. First, it acts as a medium of exchange, allowing us to buy and sell goods easily. Second, it serves as a unit of account, helping us measure the value of different items. Third, it functions as a store of value, enabling us to save for future use. Before the invention of money, people relied on the barter system. This system involved directly exchanging goods and services for other goods and services. For instance, a farmer might trade a bushel of wheat for a pair of shoes. Barter was the primary means of trade in early human societies. It allowed people to obtain what they needed without the use of currency. The barter system had several advantages. It was simple and straightforward. People could trade directly for what they needed. It also fostered a sense of community. Bartering required people to interact and negotiate with one another. However, the barter system also had significant limitations. One major problem was the double coincidence of wants. This meant that for a trade to occur, each party had to want what the other was offering. This made trade inefficient and time-consuming. The invention of currency marked a pivotal moment in economic history. Early forms of money varied widely across different cultures. In some parts of Africa, cowrie shells were used as currency. In ancient China, people used miniature replicas of tools cast in bronze. These early currencies shared a common trait. They were widely accepted within their respective societies as a medium of exchange. The transition to metal coins was a significant development. Coins offered several advantages over earlier forms of currency. They were durable, portable, and could be easily standardized. The first true coins are believed to have originated in Lydia, now part of modern Turkey, around 600 BCE. These coins were made of electrum, a naturally occurring alloy of gold and silver. The use of coins quickly spread throughout the ancient world. The Greeks and Romans further refined the concept, creating elaborate systems of coinage. The widespread adoption of coinage facilitated trade across vast distances and between different cultures. As trade and commerce expanded, the need for safe storage of money grew. This led to the emergence of banks. The earliest banks were often associated with religious institutions. Temples served as secure locations for storing valuables. In ancient Mesopotamia, priests acted as financial intermediaries, accepting deposits and making loans. The modern concept of banking began to take shape in medieval and Renaissance Italy. Cities like Venice and Florence became centers of international trade. Merchant banks emerged to facilitate these complex transactions. These banks provided a range of services. They exchanged currencies, transferred money between distant cities, and provided loans to merchants and rulers. One of the most significant innovations in banking was the development of fractional reserve banking. This system allowed banks to lend out a portion of their deposits while keeping only a fraction in reserve. Section 5. Paper money, the promise of value. The invention of paper money was a revolutionary step in currency evolution. It began in China during the Tang dynasty between 618 and 907 CE. The first paper money was promissory notes. These certificates could be exchanged for coins. Merchants used them to avoid carrying heavy metal coins. Paper money was lighter and easier to transport. It required trust in the issuing authority. Early paper currencies were backed by precious metals. Europe adopted paper money much later. In the 17th century, English goldsmiths issued receipts for stored gold. These receipts circulated as currency. Eventually, governments took over issuing paper currency. Section 6. The Plastic Revolution. Credit cards and electronic payments. The 20th century saw another major revolution in the form of money, the rise of credit cards. The concept of credit is ancient, but the modern credit card emerged in the mid-20th century. In 1950, Diners Club issued the first credit card for restaurant payments. This was quickly followed by other companies offering similar services. Credit cards offered unprecedented convenience and flexibility. They allowed consumers to make purchases without carrying cash. They also provided a short-term loan, allowing people to buy now and pay later. This had a profound impact on consumer behavior and the retail industry. It made large purchases more accessible and changed how people managed their personal finances. The advent of electronic payment systems further transformed the landscape. With the rise of computers and telecommunications, money could be transferred instantly across vast distances. This led to the development of electronic funds transfer systems. Section 7. The Digital Age, the Emergence of Cryptocurrencies. The early 21st century witnessed a radical new development in the evolution of money, the birth of cryptocurrencies. Bitcoin, the first and most famous cryptocurrency, was introduced in 2009 by an anonymous person or group using the pseudonym Satoshi Nakamoto. Unlike traditional currencies, Bitcoin is not issued or regulated by any central authority. Cryptocurrencies operate on a technology called blockchain. This is a decentralized ledger that records all transactions across a network of computers. The blockchain ensures transparency and security without the need for a central authority. This revolutionary technology has the potential to transform not just finance, but many other industries as well. Bitcoin's emergence sparked a wave of innovation in the cryptocurrency space. Section 8. The Future of Money, Trends and Possibilities. As we look to the future, several trends are shaping the evolution of money. One significant development is the concept of central bank digital currencies. Many countries are exploring or implementing digital versions of their national currencies. These CBDCs could combine the benefits of cryptocurrencies with the stability and backing of traditional currencies. Another trend is the increasing integration of financial services with technology, often referred to as fintech. This includes innovations like robo-advisors for investment management and peer-to-peer lending platforms. These technologies are making financial services more accessible and personalized. They have the potential to democratize access to banking and investment services. The concept of programmable money is also gaining traction. Section 9. Conclusion: Money's ongoing evolution. The evolution of money is a testament to human ingenuity and adaptability. From simple barter systems to complex digital currencies, money has continuously evolved to meet the changing needs of society. Each step in this evolution has brought new opportunities and challenges. The journey from shells and coins to paper money and credit cards reflects broader changes in society. It mirrors advances in technology, shifts in social structures, and changes in economic thinking. The recent emergence of cryptocurrencies and blockchain technology represents the latest chapter in this ongoing story. As we look to the future, it's clear that the concept of money will continue to evolve. Digital technologies are reshaping our understanding of value and exchange.